to Geared for Growth. I'm your host, Mike Mortlock, Managing Director of MCG Quantity Surveyors. Today in this episode, we're talking everything valuation, specifically how a valuation background has helped Sam Powell, who's our guest today and the lead analyst at Hello Haus Australia, how it's helped him to analyse comparable sales with that competitive advantage that he has with that background as a valuer. We speak to him about how this due diligence or this comparable sales analysis should be done, how people typically approach that, and where people are getting it wrong. He also gives us some great insights into how to calculate the potential value of a property, and also gives us some cautionary advice on the value of perhaps paying a little bit extra for that A-grade quality asset because of the opportunity costs. It's an awesome interview with Sam, which I'm sure you're going to take something away from. Here's Sam. Sam Powell, thanks for joining me on Geared for Growth.
Mike Mortlock, thanks for having me.
It's all very formal, which doesn't match a man sitting in the Gold Coast with no shoes and a t-shirt on.
Yes, I'm wearing pants today, not Speedos. So it's a good time to be alive.
There's a few people in the property game in the Gold Coast that I'm fortunate enough to catch up with when I'm in town. And yeah, I'm normally the only guy wearing a suit. It's just not a thing that you do.
Yes, yeah, we've met a few times. And I don't know, to each their own. I've spent many years wearing a suit and tie and dressing up and ironing my shirt. And I got to a point where I prefer just to be comfortable. It's more so what's in my brain. That's what I'm wearing is important in my mind. But what do you think?
I completely agree. I've always said to people, the more successful I become, the worse I'm going to dress. And I'm normally wearing a suit when I say that. So obviously not successful at all. But you're right. People are interested based on what's between your ears, and especially on the audio version of this podcast where they can't even see you at all. But let's talk about your past life. So you were a property valuer, so you had to be prim and proper and sensible and well-dressed. Now you work in the buyer's agency space where, well, you're all cowboys, aren't you? But I'm interested in the skill set that you developed as a valuer and how that prepared you to be an analyst from a buyer's agent's point of view.
Yeah. Well, it's a pretty in-depth, process to become a property valuer itself, right? So you have to do a certain degree that's approved by the Australian Property Institute and the Queensland Surveyors Registration Board. But then the other side of it is you need to go forward, be an assistant valuer for a few years, get all your tickets signed off. So it's a pretty full-on process. But then there is definitely differences between being a valuer and then also being a property buyer, which no doubt we'll touch on. But there's a lot of training involved to get to where you're at, and you don't get your valuer's registration too easily. You have to sit in front of two boards. They analyse your commercial side, your residential side, and development as well. And then they grill you. It's this really intense environment. I remember doing it myself, and I was sweating in my suit, maybe because I was wearing a tie at the time.
Which is just thankful that that's many moons ago for you. But you've of course got that rigor and that valuation methodology behind you. How do you think you view property now compared to today? Sorry, how do you view property today compared to the way that you looked at it when it was essentially as I guess a contact of the bank? You're there to certify whether what they're going to be, say, lending for has a certain level of risk that they're happy with, that the agreed price is within the bounds. How does it sort of change from that viewpoint to what you have today?
Yeah, good question. So from a valuer's mindset, right, like you're going in there, I refer to it, you're more like a risk assessor for the bank. So looking at like that way, you're constantly looking at what is the value of this property as today? So you're looking at comparable sales evidence. there's a few barriers that are there as well for valuers. So we need to use settled sales, and generally within the last 3 to 6 months is that time frame. What I've found a big difference in the mindset shift is, especially in markets that are growing quite rapidly, those sales that you have to wait to be settled quite often aren't a true reflection of what that value is, or that heat in the market. So, shifting into the buy side, I'm now using data to help me feel where that heat's coming from, and then just constantly being in contact with those sales agents on the ground there to help me understand where that value is. And a good tip on that front is find those properties that are comparable, that are under offer, and see what they've actually gone under offer for. Does that make sense?
Yeah. And when it comes to the valuers having to use that settled methodology, obviously they're behind the 8 ball. So when it comes to a real value, I mean, if you went to auction on a property with a valuer's report looking at maybe 3 or 6 month old settled properties in a hot market, you're going to be an underbidder by a huge margin, right? But you're able to say, okay, well, here's actually what's happening, and here is maybe not necessarily a valuation in the same sense, but here is what people are likely to be prepared to pay for something today. So do you feel a bit less sort of hamstrung by that?
Yeah, so there's, I guess, touching on the valuation side as well. So valuers it's a legal document, and you can be sued from whether the banks or the person who's paying you for that long form report if you do get it wrong. So I try to teach people to go, well, you got to understand, you walk a mile in someone's shoes, right, to understand where they're at. So they're constantly looking at it from that mindset. And whilst it's not that common generally from a bank perspective, it has happened. And growing up in the valuation industry in that GFC period, it was stuck in people's brains. Valuers were getting sued, and that's something that just sticks with people throughout their time. So the shift into it now we do, like, as a buyer, I'm appraising these properties. I'm not physically going in. I'm not inspecting them, but I am looking at, it's all the same methodology, and with data and technology, you actually can do a really efficient job in understanding where that value sits. What I'm doing differently now is a lot more agent contact, but also you still have to keep in the mindset of the valuer to say, well, even if you get something under contract, if it's not, if you're paying too much for it, it's going to get knocked back on evaluation. So the client loses faith in your ability if you're paying too much, and that's fair enough. But also, it's a massive stuff around process. So the accuracy for me is really key at this point in time. And there's many different ways to go about it in regards to how to value it. But yeah, it's just a skill set you develop over the years.
How does it differ for you as a buyer's agent looking at future price performance? Because I mean, that's what most people that you and I would talk to are in the game of, is to purchase an asset that in time will be worth asset price times 1, times 10, times whatever. People are looking for that growth, whereas you're trained more in the historical, these are factual values, let's see how they compare. And I know valuation reports will talk about, the general economy, the local market, but it's not as much high stakes as to what will happen over time. I mean, the banks just really want to know, is it worth what the person is paying for it today? They're not typically interested in whether this is a good investment. How does that change the way that you look at it?
Oh, well, I mean, when I used to value property, I'd always, you try to find like with a lot of on the residential side. So a lot of that has really helped me in the process of being that buyer's agent, where I've seen different market cycles come through and properties performing. So I've brought that into the analysis and the due diligence process as a buyer's agent. But you're still looking at, from a valuer, like you're not going to be looking at comparable sales that are on a main road if your properties, in a cul-de-sac, so to speak.
Yeah.
It's not comparable. In regards to like looking at like locations and the growth side of things, that comes from location research, which is different to valuation. But the analytical brain still, it works. The synergies are quite good. So I'm looking at that. Well, if we're buying into a heated market and looking at days on market, looking at low vacancy rates, looking at these short-term metrics that are going to help contribute to that future growth, that's a big part that really adds fuel to the analysis fire in that sense. So it helps me understand, well, whilst all comparables might be, say, $600,000, and this property itself, it's on the market, I'd be looking at that. Well, if they're settled, and they might even be, a good tip and trick is I add the growth rate. So I might see a property that sold 3 months ago, but then I look at the data and it's showing that it's had a 3% growth rate over the last 3 months. I'll then use that as a comparable, add that growth rate to help me start to formulate. It's like a thesis, basically. You're adding more and more layers of confluence to give you that confidence, because as we all know, like, market value is what someone's willing to pay for it on the day. It's a willing buyer, willing seller, local agent, length transaction. So I'm trying to really do everything I possibly can to build confidence in this figure, which is what I call the appraisal figure. And that's where, my job is to protect people from not overpaying, right? And then the skill set of negotiation go hand in hand to really get that property at that lowest price possible. So looking at those sort of the data on that side, going back to your question, it does help. And then really getting close into with the agent and understanding where the other offers sit. There's an art in that as well.
Yeah, a whole nother subject, I assume. When it comes to your average punter, your average buyer, what sort of level of due diligence do they do around comparables? Is it your experience that people will come to you and say, okay, well, I've done let's say the CoreLogic AVM, or I've done the CMA, the comparative market analysis, or do they just kind of say, look, there's 6 for sale, they're all about the same, and this one's a little bit cheaper, so it's probably good value? I'm just wondering, what level of sophistication do people normally have, or do they really consider, okay, well, I really need to seriously look to see if I am overpaying?
Well, I mean, the answer to that question is everyone's got an opinion, right? So
Right.
Some people do a really in-depth level of analysis, and they're the ones that often suffer from analysis paralysis, where they can't pull that trigger. At the moment, in certain areas that we're buying, because they are growing, and then we're seeing, obviously, Sydney's moving as well, and the rest of the nation is starting to see a bit more heat. It's that conversation that we're having, is saying, whilst comparables put this at $600,000, what's the opportunity cost if you were to pay that extra $5,000 today and secure this property? Then this probably comes around once every 3 months. So in 3 months' time, this is going to be worth $615,000 as an example, and therefore 605 would be considered cheap. So there's an education process on that front. Which is difficult for people to get their head around. But in answering to your question as to most people would look at, they try to do the best with like. So if you're looking at a 4-bedroom, 2-bath, comparing it in the same suburb with other 4-bedroom, 2-bathroom houses. Now, that can be good. The issue is that different streets perform differently, right, in the suburb. And there's so many different aspects, even to us, like, no one house is the same in the markets that we're buying in, because they are established. So there's different land sizes, the different living area sizes. And then you look at the street itself, like, you're going to get more premiums in cul-de-sac locations than you would in, just your standard drive-through streets. And then you go to your main thoroughfares with, bus routes on them. And there's so many different intricacies. Even on a T intersection, the premiums get paid on those properties that everyone wants, that family unit, and that's what I'm trying to drive people into investing in, because that's the emotional premium you'll get on the back end, if that makes sense.
Yeah, no, it does make sense. And that's where I think people will talk about, okay, well, you want it to appeal to investors and owner occupiers alike, because otherwise you're minimizing one, the major driver. If you're just looking at investor specific stock, if it's something that a family wouldn't want to move into, then yeah, you kind of think, well, it doesn't really matter, I'm not going to sell it, but it does impact the value, right? The Geared for Growth Property Investing podcast is presented by our business, MCG Quantity Surveyors. If you're an investor or a property professional looking to get the best tax depreciation deductions for yourself or your clients, please get in touch with us at mcgqs.com.au. It's our mission to help as many property investors as we can to maximise their claims and maximise their property education as well.
Yeah, it does. And I mean, to each their own. Like an investor stock for me, I prefer that owner-occupier appeal is really important to me. If you're getting your cash flow and that's making you $10 a week, that's $500 a year in positive cash flow. If you get the capital growth side of it right, you might take a negative cash flow, but you might be having that 20,000 plus in capital growth. Which one would you prefer? It does depend on the individual, obviously, but from a net profit basis, the capital growth will outweigh that cash flow. In my opinion, obviously, where people go wrong with their comparables is they're just looking on a broad base approach, and there's so many different areas. So you've got from your location in the street is very important within that suburb, and then going into, well, what's that street appeal look like? What's the size of the property? What aspect is the backyard facing? North is obviously more attractive with that sun, and then they get that premium. People often don't understand that, and then even having that mindset of, well, solar panels cost X, a pool costs this, a front fence costs this sort of money. Like, those little things do add up quite quickly, and you can get that $50,000 difference, and people are looking at it saying, well, that's a 4-bedroom, 2-bathroom that sold for $550. Why would I pay $600 for this? And when you start breaking it down, people often come to that realization as well. It's just that, how are they supposed to know? Like, we didn't get taught this at school. Yeah.
It can appear like a bit of a dark art, and to make matters worse and muddy the waters, we do have these automated valuation models, and even I've talked about on this podcast before, TV ads of people walking around, and the agent says, "Oh, it's going to go for 900," and then they see this little ding in their app, and they go, "Oh, it's actually only worth 870." Thank you, XYZ Bank. And those things are, I actually think AVMs are exceptionally clever, and I think if you put that over the entire market, you'll probably find the variance is minimal. But on a case by case basis, it can be so misleading. Do you feel how do you feel those AVMs fit in? Do you think that they are just treated like a little bit of a guide, or do you think people use them as gospel and they can be a little bit troublesome?
Definitely troublesome. So I'm a big proponent of, like, the AVMs should not be relied upon. It can be one of those layers of confluence that you can use in your analysis process. And even for me as a professional buyer now, is that I'm looking at those AVMs because a lot of people are out there. They're being driven by their mortgage brokers or their banks, and even you go on to search the address and an AVM will pop up, and that's conditioning them to think, oh, well, this property is worth X. So I like to sort of look at that and go, well, if we're close, which, don't get me wrong, the AVMs are getting a lot better, right? And like, eventually, you hope to think that it could be even more accurate for these people. But even like a $20,000 difference, that's too much for me. Like, you're overspending based on some kind of figure. What I'd move to with those AVMs is, if you're buying in locations where there's a lot of similar properties, issue with that is you might be on the very outskirts of town, but if they're all built in a similar age, similar accommodation, that's where they start to get really accurate because they've got a lot more data set to pull upon. And then they also grab the recent sale of that property and then add that growth rate to that property as well in the back end. So if you get a property that it might have sold 2 or 3 years ago, if you can get that growth data from one of the data sources, that you can add that percentage on top, that sort of definitely helps. And I found that some of those properties that have recently sold are more accurate, if it's within that 3-year period of its last sale.
Yeah, okay. I'm wondering, when it comes to, say, revaluing a property, or even maybe when you're purchasing, there are some times that you'll see the AVM just seems to have overcooked the property. I've got a property myself where I know it's kind of like a little bit unique and not in a positive way. And the AVM makes it look like a darling. Are there any sort of times where you can kind of use the AVMs almost like against the bank? If you're looking to, say, refinance at a fairly low LVR and you know that they're only ever going to do a desktop val, is that like a little trick? Is there something in it for people?
Sounds like you've got some insider knowledge around this.
I'll give you some background, and I'll ask a second question just to try and confuse you even more. I almost was a valuer at one point in time. It's a long story. And the one thing that I kind of learnt is the value of the comparables, and I certainly used the opportunities presented to change the comparables. So, for example, I bought a 2-bedroom house with 2 living spaces and converted that to a 3-bedroom to really force a valuer to look at different comparables, and that kind of worked for me. I don't know if that's a universally valuable thing. Would you consider that a worthwhile strategy? And then also that AVM thing, if you can find an error in it, is it likely that a bank could refinance based on an AVM that's just overcooked somehow?
Yeah, well, we've had clients in the past that they can, if we buy it and the AVM is showing that, say, as an example, it's on the AVM, it's saying 900,000. We were able to secure that property for $820,000. They could then refinance that day, and if it was within those high like LVRs or lower LVRs, so 70% or below, they're just doing the bank's doing a desktop valuation, and they're going to value it more in line with what the AVM is, even though they've just purchased this property, which doesn't make really much logical sense to me from a risk perspective from the banks. But definitely,
that's their problem.
Yeah.
Let's not worry about the banks; they'll be okay. They're still going to make profits. But I'm just wondering, from an insider's perspective, and with all due respect to the API and various institutes that you probably want to remain a member of, are there any tips and tricks that a valuer can give that you can be a little bit strategic around, those valuations and especially those revals?
Yeah, I mean, there's always strategies in everything, and you want to try and find that competitive edge. I mean, at the end of the day, it's it's hundreds of thousands, often millions of dollars that you're purchasing with, so you do want to get it right regardless. But with residential, your direct comparison is really your best method. But you got to understand the market cycle and what the market you're buying in, and obviously, if you can lean on people that do it every single day, then obviously you'll be at an advantageous position. But it's not to say that those can't try it themselves. It is, it's that art and science to it, as we talk about. But at the end of the day, you got to have a go and you do the best with what you've got. If you are questioning it, then obviously reach out and have a conversation with those that do it every day.
Yeah. And on that conversation, we sort of talked a little bit before about you get those hyper analytical people that sort of say, Sam, I've done this detailed analysis and I think it's worth X. And then you've got other people going, how do we know what it's worth? Who do you prepare to work with? And where do you see people getting it wrong? From especially the analytical people, and we always laugh about engineers. They seem to be the most anal with the data and the analysis and that sort of stuff, which puts them in great stead in their careers. But is that something that you think sort of people fall foul of because their analysis is based on some flawed notions?
Yeah, I wouldn't say they're flawed. There's because a lot of them do their research, and it's definitely an emotional time for people. It just comes down to the property itself, right? Like, you can be as analytical as possible, and you can have this hard figure where you only see value up to, similar to what I touched on before. Then I like to encourage people to ask that question. Well, are you willing to lose this quality asset, which it may not come around too often, for a few $1,000s? And generally the answer is no. But it's having that mind set in place, and having that I guess you can get down to the dollar. For some people, they might even analyze the full replacement costs, add in the depreciation side of it, and then this is the dollar I want, not paying anything more. I'd just say go for it. See where you're at in 3 months, 6 months, 12 months. If you're still in the market, then you got to look within and think that maybe if you want to buy a property or not. And the biggest thing about capital growth, I'd say, is it's better to pay a fair price for a good asset than a good price for a fair asset, because the good asset is going to compound in growth over time, and that's what's going to help to draw down upon your portfolio and continue to add. And from a risk perspective point of view, if we are in a downturn period, which market cycles do indicate that eventually we are in downturns, if you had to sell that asset, you want the asset that's the most desirable in that location, because then you're not going to be fire selling it during that period, if that makes sense.
Yeah. I think that's a really interesting insight from someone like yourself, a valuer, right? Is that people might think, oh, well, Sam's special skill is hunting out bargains, right? He's a valuer. He knows the value. He'll be able to get properties cheaper. But you're actually kind of saying, well, forget about that. Let's talk about securing a quality asset. And sometimes it's worth paying a little bit more than what your hard and fast appraisal might be of that, because you want something that's going to suffer less in downturns because it's a sought after quality asset, and you want something that's going to grow in value. And then there's an opportunity cost. If you're not purchasing that property, you're missing out on that future growth. So do you think that's sort of like a bit like me with a tax depreciation brain? People say, what's the best property for depreciation? And I'll go then to describe something that I wouldn't want to buy. And I'll say you shouldn't buy for depreciation. Do you think people are a little bit surprised by that?
Yes and no, I suppose. The skill set is me bringing confidence to say this is where I see value up to. Once again, I'm just a single person. I've assessed over 15,000 properties in my time, which gives me that sort of background. Wow. But I'm not right all the time. Sometimes I'm a little bit under, sometimes a little bit over. I prefer to be under. Like in Hello Haus, like our whole target is to be within 2% of the purchase price every single time, and our results indicate that we're actually within negative 1% of that. So. As an example, if I appraise a property at 498,000, generally it sells for like 500,000. So I'd prefer to be conservative on that front. But we have those open conversations. This is where we see value too, and then we also look at the cash flow component as well, from an investor's point of view. But from an owner occupier, then we look at it and go, well, these properties don't come up too often, and we're here for you, and we're happy to be on this longer journey. But, it's where you see value at the end of the day, and just having those open, transparent conversations to say, well, we need this walk away price, and we have this hard conversation now, because if you're doing that when you're halfway through a negotiation, that's where the emotion starts coming out, and then people aren't making those educated decisions. So,
Yeah.
To each their own.
Yeah. So to finish this off, Sam, if there's any advice you could give to people that are looking to, let's say, not use someone like yourself to purchase an investment property themselves, and they're wanting to get some sort of safe footing, some sort of foundation to give them the confidence. Obviously, we've talked about comparables, but what's your best advice to them to try and get as clear or as close to what that property is likely to sell for?
Yeah, I'd say there's some really great free resources out there. So jumping on realestate.com.au, going into the sold section, finding where your property actually is. So your best comparable sales are the ones that are in the street. They might not have been gone through for the past, say, 12 months. But as I said before, you can add that growth data onto that. And then looking around that exact location, then I'd be looking at properties that are also on the market to see what those comparables are, and targeting the ones that are saying under offer, calling those real estate agents, asking what it actually went for, what their thoughts are on this property that they're looking at buying, and utilizing all those different layers of, I guess, feedback data to help you come to a more confident figure. And then as an investor, running your cash flow and going, well, what's this probably going to cost me to hold? Is that within my budget? And then just having the confidence to pull the trigger, because you don't know what the real estate agent is really meaning until you engage in that fight. And that's where the negotiation skill set really does come in as well.
Yeah, I love that. Sam, if people are wanting to get in touch with you, what's the best way to do that?
Well, I'm the lead analyst at Hello Haus. So hellohaus.co is our website. Jump on board. I also run I'm a co-host of a property podcast called Property Pals Australia with my best mate Jared, and we're having these conversations every once a week to try and educate people. But the big part of what we do is obviously Hello Haus, and working with Scott Agate, the founder there. We're really trying to transform, I guess, the way people buy property and run a really open and transparent process, and help people with the skill sets that Scott and I have developed over the past. Well, he's a bit older than me, mate. He's been doing it for 30 odd years, 28 years. I've only been doing it for about 15. So there we go.
We stopped short of talking about negotiation, and that the motivation behind that is that we did a negotiation special with Scott, so we didn't want to tread on the toes there and focus in on the val, which I think we've done pretty well. Sam, thank you very much for sharing all of those insights with us today.
No worries, Mike. Yes, I thought that you would have touched base a few times with the negotiation expert, but happy to help out, and thanks for the time. I really appreciate it.
Oh, of course. Pleasure to chat. Cheers, Sam.
Cheers, Mike.